Share buybacks are a way for companies to use their profits or debt to repurchase their own shares from the market. This reduces the number of outstanding shares and increases the earnings per share and the stock price. But why do companies buy back their own shares? There are several reasons. One is to return money to shareholders in a tax-efficient way. Unlike dividends, which are taxed as income, share buybacks are taxed as capital gains when investors sell their shares. This can lower the tax burden for shareholders and increase their returns. Another reason is to boost the share price and the shareholder value. When a company buys back its own shares, it creates more demand for them and reduces the supply. This can drive up the price and make the shares more attractive to investors. It also increases the earnings per share, which is a measure of profitability. By reducing the number of shares, the company can increase the amount of profit allocated to each share, making them more valuable. A third reason is to prevent hostile takeovers or dilution. Sometimes, a company may buy back its own shares to reduce the risk of another company acquiring a controlling stake in it. By owning more of its own shares, the company can make it harder for an outsider to gain influence or power. Alternatively, a company may buy back its own shares to offset the dilution caused by issuing new shares for employee compensation or acquisitions. By doing so, the company can maintain its earnings per share and avoid disappointing investors. How do companies buy back their own shares? There are two main ways: open market purchases and tender offers. Open market purchases are when a company buys its own shares on the stock exchange, just like any other investor. This is the most common method of share buybacks, and it gives the company flexibility and discretion over when and how much to buy. Tender offers are when a company makes an offer to its shareholders to buy back a specific number of shares at a premium to the market price within a certain time frame. This method is less common and more expensive, but it allows the company to buy back a large amount of shares quickly and efficiently. Share buybacks can have positive effects on the market and the economy, such as increasing shareholder value, boosting investor confidence, and stimulating economic growth. However, they can also have negative effects, such as reducing investment in research and development, increasing debt levels, and creating market distortions. Therefore, share buybacks should be evaluated carefully and used wisely by companies and investors alike. Share buybacks are a common way for companies to return cash to their shareholders, but they can also have dangerous consequences for the economy. In this section, we will discuss how buybacks deprive companies of the liquidity and investment that they need to cope with downturns and innovate in competitive markets. We will also mention how buybacks are fueled by artificially low interest rates and tax cuts that benefit shareholders and executives at the expense of workers and society. First, let's define what share buybacks are. Share buybacks, also known as stock repurchases, are when a company uses its own cash to buy back some of its outstanding shares from the market. This reduces the number of shares available for trading, which increases the earnings per share and the share price of the remaining shares. This can boost the value of the company and make it more attractive to investors. However, buybacks also have a downside. When companies spend their cash on buybacks, they have less money to invest in their productive capabilities, such as research and development, capital expenditures, mergers and acquisitions, and employee training and compensation. These investments are essential for companies to maintain their competitive edge, create new products and services, and adapt to changing customer needs and market conditions. Moreover, when companies do buybacks, they reduce their liquidity, which is the amount of cash and other assets that they can easily convert into cash. Liquidity is important for companies to survive economic shocks, such as recessions, pandemics, or natural disasters. Without enough liquidity, companies may face difficulties in paying their debts, suppliers, employees, and taxes. They may also have to cut costs by laying off workers, closing plants, or selling assets. These actions can harm the company's long-term performance and growth potential. In addition, buybacks can create a vicious cycle of financial fragility. Many companies finance their buybacks by issuing debt, which increases their leverage and interest expenses.